John AG here. John AG Markets. Silver bounced to 84. 6 million ounces reportedly left COMEX vaults overnight. And the question circulating across every precious metals channel right now is the same one. Are there only days of silver left in the vaults? Today I'm going to answer that question with real numbers. Not sensational ones, not exaggerated ones, the actual publicly available data. And the answer is more nuanced and honestly more interesting than most of what you're hearing. Let's get into it. Silver prices show moderate volatility at $84.37 per ounce internationally. Due to ongoing geopolitical concerns and persistent industrial demand, international silver prices are exhibiting mild volatility. Following the severe fluctuations seen earlier this month, the white metal is still consolidating. Now let me put that $84 in context because this number means very different things depending on where you're looking at it from. Silver sharply declined from $116.61 per ounce on January 28th to $70.90 on February 5th. Barely a week later. That marked an almost 40% decline, which is steep even for a metal known for significant price volatility. Still, the price is rising again, and now at the start of March, it's often been listed in the $80 to $89 per ounce range. So we're in a recovery, but the recovery is incomplete. Silver futures rallied above $121 on January 29th before crashing below $64 on February 6th. The midpoint of that volatile range sits around $92.50. We're trading below it. That tells you technically we haven't recovered even half the ground lost in the January crash. Silver traded near $80 on March 6th as firm yields and a strong dollar capped a cautious rebound. If yields stay firm and the dollar remains well supported, rallies may continue to lose force before they can fully develop. In that setup, a breakback under $81 would leave silver exposed to another round of defensive positioning and keep the tone cautious. That's the honest picture. Silver is bouncing, but bouncing into resistance, not breaking through it. Now let's talk about the headline that's driving the conversation. 6 million ounces reportedly leaving COMEX vaults overnight. Is that real? And what does it actually mean? First, the broader context. COMEX registered silver saw net outflows of 22.3 million ounces over the past 30 days. Total net outflows across all categories, 56.6 million ounces, data as of March 5th, 2026. So yes, metal is leaving, and it's been leaving consistently. There are currently 6.9 times more paper silver than deliverable metal. The COMEX stress index combines coverage ratio, inventory trend, paper leverage, and vault outflows into a single 0 to 100 score. Higher values signal greater physical supply stress. The current stress level sits at 81, against an all-time high of 88. That's a system under genuine pressure. No question about it, but here's the part I need to be honest with you about, because I see this number getting misrepresented across this space. The inventory depletion estimate is approximately 80 trading days, if the recent withdrawal pace continues. That's roughly 4 months, not 15 days, not 24 days, not only days left. 80 trading days at the current withdrawal rate. I know that's less exciting than a countdown clock to zero, but it's the real number. And I think serving you accurate data is more important than serving you adrenaline. Now, that said, 80 days is still historically tight. COMEX registered silver has fallen from 167.7 million ounces in October 2025 to 103.5 million ounces in early February 2026, a 38% decline in just over 3 months. The drainage rate has accelerated to 785,000 ounces per day, and the pace can accelerate. Between early and mid-January, in just 7 days, 33.45 million ounces of silver were physically withdrawn for delivery. That meant roughly 26% of COMEX's registered inventory disappeared in a single week. So can 6 million ounces leave in a single overnight session? Absolutely. It's happened before. And if the March delivery pace continues, it can happen again. But extrapolating one overnight drain into days left is not supported by the math. The structural pressure is real enough. It doesn't need to be exaggerated. Let's zoom in on March because this is where the structural story gets genuinely unprecedented. CME data shows 10,526 contracts, that's 52.63 million ounces, standing for March delivery against 86.13 million ounces of registered inventory occurring immediately after February 2026, delivered 5,036 contracts or 25.18 million ounces, the highest February delivery volume in modern COMEX history. On first notice day for the March contract, delivery notices were issued for 10,526 contracts, representing roughly 52.63 million ounces of silver. This delivery demand represents more than 60% of the total registered inventory. COMEX has delivered 86.4% of its current registered inventory in just 60 days while maintaining sufficient inventory to cover demand. This represents the highest 2-month delivery rate in exchange history. That last point deserves attention. The system hasn't broken. It's been tested harder than ever before, and it's held, so far. But the margin for error is thinner than it's ever been. Now here's a critical piece of context that I rarely see discussed on YouTube. A COMEX delivery typically means the transfer of a warehouse receipt, not physical silver leaving the vault. The metal often stays in storage unless the new owner chooses to withdraw it. This distinction is critical when interpreting headlines about surging deliveries. That does not mean deliveries don't matter. They absolutely do. They represent changing ownership of real metal. But when someone tells you 52 million ounces demanded for delivery, that doesn't automatically mean 52 million ounces are walking out the vault door tomorrow. Some of it changes hands on paper while remaining in the same building. Understanding this mechanism makes you a better analyst than most people in this space. Now let's talk about the Eastern market, because this is where I see the most misinformation in this niche. Shanghai silver is trading at a premium to Western spot. That's real. Shanghai silver often trades at a premium or discount to Western markets due to differences in physical demand, supply flows, and local market conditions. Persistent premiums typically indicate strong Chinese demand or restricted supply. Because China is the world's largest industrial consumer of silver, movements in the Shanghai silver price can reveal underlying supply and demand dynamics that may not immediately appear in Western futures markets. But here's the nuance that matters. The SGE benchmark price itself does not include VAT, but China levies a 13% value-added tax on silver imports. This tax is a major component of the Shanghai premium. When Chinese silver trades above Western spot, a significant portion of that gap comes from VAT and import costs rather than pure demand. In a simplified example, a Chinese buyer withdrawing metal from the exchange system would pay about 113 USD per ounce, even though the benchmark spot price is 100 USD. So when you see a channel quoting $96 Shanghai versus $84 Western, that's a 14% premium. You need to understand that a significant chunk of that gap is structural tax, not pure demand signal. The premium is real as a directional indicator. The Shanghai premium acts as a real-time gauge of Chinese physical demand. When it rises, it often precedes global price moves. But the raw dollar gap overstates the arbitrage and the divergence if you don't account for the tax layer. I want you to understand the mechanism, not just the headline number. Now the bear case, because if you only hear the bull case, you're not informed, you're positioned. 1. Paper markets still dominate short-term price discovery. Silver crashed 15.8% in a single session on March 3rd, while physical delivery hit all-time records the same day. Paper and physical diverge violently. Short-term traders must respect that reality. 2. There is currently no strong evidence that the COMEX is at risk of defaulting in March. While open interest in silver contracts exceeds registered inventory, most futures contracts are settled or rolled over before delivery. The exchange has tools, margin hikes, cash settlement, eligible to registered reclassification that give it significant capacity to manage stress without a formal failure. 3. The U.S. 10-year yield held near 4.14% on Friday after several straight daily increases, reflecting concern that stronger energy prices could keep inflation pressure alive. The dollar has not backed off much either. Even with some intraday softness, the U.S. currency index stayed around 99.3 on March 6th and remained well above where it traded a month ago, which continues to limit upside room for metals priced in dollars. 4. J.P. Morgan Global Research sees silver prices averaging $81 per ounce in 2026, more than double its average in 2025, but this depends on many factors, including global demand. That's roughly where we are right now. The institutional consensus is not for a moonshot. It's for consolidation at elevated levels. 5. Even if the price of the metal breaks $200 this March or comes close to it, there's no guarantee that it will stay there for particularly long. It could even fall significantly, as it demonstrably did after rising to the $100 price point in recent weeks. Volatility cuts both ways, always has. That is the bear case. It's real. And it deserves weight equal to the bull case in your thinking. Now the structural case, because this is what outlasts any single overnight vault drain. Since 2021, the global silver market has run in deficit for 5 consecutive years. Industry estimates suggest cumulative shortfalls of roughly 820 million ounces between 2021 and 2025, nearly equivalent to a full year of mine production. Silver was officially added to the U.S. critical minerals list in late 2025, recognizing its indispensable role in green energy and advanced electronics. Many large-scale electronics and solar manufacturers are reportedly negotiating offtake agreements directly with primary silver producers to ensure their production lines remain operational. This shift suggests that the era of relying on just-in-time delivery from exchange warehouses may be coming to an end. Tech giants like Samsung and Tesla are securing physical silver through direct deals, bypassing exchanges, signaling a shift to vertical integration. That's not a headline. That's a structural shift in how silver reaches the market. When Samsung pays cash to restart a mine and locks up 100% of its output for 2 years instead of buying on COMEX, that's metal that will never see an exchange warehouse. That's permanent supply removal from the deliverable pool. The remaining approximately 659 million ounces of the cumulative deficit was absorbed by irreversible industrial consumption, solar panels, electronics, EVs, or private storage. This metal cannot return to exchanges without price incentives significantly above current levels. That's the bull case, not hype, not conspiracy, just math. The deficit is real, the industrial demand is permanent, and the exchange inventory is at historic lows. Let me close with a framework rather than a prediction, because predictions are entertainment. Frameworks are tools. The only days left framing makes for a great thumbnail. But the real story is both less dramatic and more significant than a countdown clock. The real story is that COMEX inventories are depleting at 22 million ounces per month. Delivery demand is at all-time highs. Industrial users are bypassing exchanges entirely. And the 5-year cumulative deficit has consumed metal that cannot come back. That's not a days to zero story. It's a structural repricing story. And structural stories play out over months and quarters, not overnight. My honest view, and I'll tell you next week if I was wrong, is that $84 silver with these fundamentals underneath it is more coiled spring than dead cat bounce. But the spring can stay compressed longer than YouTube expects. For short-term traders, respect the volatility and the dollar headwind. For long-term holders, the structural deficit doesn't care about a single overnight vault report. Every number I cited today, the COMEX daily inventory data, the CME delivery reports, the JP Morgan forecast, the Shanghai premium methodology, the depletion estimate, all of it is publicly available. I'll link every primary source in the description. Verify what I've shown you, challenge it, cross-reference it. That's how you build conviction that holds when the tape moves against you. If this was useful, subscribe. Share it with someone who needs the real numbers, not just the headline, and drop your honest take in the comments. Is the COMEX drain accelerating or stabilizing? I read every single one. Invest with logic. Prepare with data. This is John A.G. John A.G. Markets.